So the news came yesterday that the Bank of England has raised its base rate from 0.1% to 0.25%. And in this video, I'm just going to talk about why they've done that and the repercussions for our wonderful lending market. Hey guys, welcome back to my channel. Now, before we get into this, please, if you haven't already, think about subscribing to the channel and give this video a nice big like for me. I would very much appreciate it. Now, as I said, the Bank of England base rate even went up by 0.15% yesterday. We're recording this on a Friday, from 0.1% to 0.25%. Now, everyone was pretty surprised that we didn't get a rate rise in November because we were starting to see that inflation was creeping up a little bit. And as we know, in the Western world, one of the greatest ways of combating inflation is to raise interest rates because that starts bringing down the cost of goods. But the Bank of England didn't do that. Now, I said at the time, I thought this was probably because we were starting to see the hints of this new variant of the coronavirus, which obviously is starting to have an effect on our way of life. Again, unfortunately, we all thought that we were out of the woods, but doesn't look like it's happening now. Maybe even going back into a lockdown in January. Fingers crossed it doesn't come to that. But the Bank of England, for whatever reason, decided to defer any interest rate rise. Now, I actually went on record, and I'm happy to hold my hands up and say that I was wrong back in November to say I think that it would be really strange if the Bank of England raised the base rate in December or January, because these months usually are the months that are most tight for people from a financial perspective here in the UK, and that perhaps it might be a good idea to defer any rate rise, which kind of everyone knew was on the cards until February. They've not taken my advice on that, and to be honest, probably rightly so, because we've actually seen an increase in inflation. Bearing in mind the target for inflation is 2%. We've actually seen an increase from September, which was 3.1%. to November 5.1%. That's a 2% increase. 2% is the target. So obviously, as I mentioned before, inflation, the cost of goods has gone up dramatically, and to combat that, the Bank of England have taken the action to raise the base rate to try and combat this quite quick rise in inflation. Now, no one's expecting, huge rises over the course of 2022. Knee-jerk reactions and large rate increases all at the same time kind of stimulate negativity in the market and can actually have an adverse effect. So I do believe that there's going to be a steady increase over the course of next year, but don't expect January, February, March massive increases in this interest rate every single month on month. We're perhaps looking at 0.25%, maybe even less on a rolling monthly basis. They may even miss out some months. It very much depends, I think, on what happens with the new pandemic in the new year, whether there is a lockdown, whether furloughs reintroduced, all of these sorts of things, and whether we see that this small increase in the interest rate actually does curb inflation, or at least curbs the growth. If it starts to curb the growth, expect a small increase in the new year, but maybe they might just allow it then to go its natural course and get it back to that 2% target, which would be good for everyone. But I know what you're thinking. What does that mean for the lending market? So at the time of recording this video, there have been no updates from any lenders to suggest any increase in product rates or pulling of any products that are currently on the market, or the introduction of any more expensive interest rates. Long may hopefully that continue over the next few weeks as we go into Christmas. But what does this first mean for those of you that already have mortgages? Okay, so let's put it into two camps here. Number one camp over on this side are those of you that have fixed rate mortgages. If you've got a fixed rate mortgage at the moment, your rate is safe, okay? You are not going to see an increase in your rate until the end of your fixed term. That is how fixed rate mortgages work, and it's one of the reasons why, particularly at the moment with the Bank of England base rate being so low, I'm certainly favouring those types of rates with my clients, because it really does give you the peace of mind that your monthly payments are going to remain the same and aren't going to go up at any point, because you are fixed for that period. It allows you to budget. So that's a really good idea to take out a fixed rate if that is the thing that you're most concerned about. Now, on the other side, we've kind of got two camps, which is the first is if you're on on the standard variable rate, which is the lender's kind of normal rate that you fall onto after you come off a fixed term. You're probably likely to see an increase over the coming weeks as the lenders basically rejig their interest rates, and they sort of increase their standard variable rates in line with the increase of the Bank of England base rate. That's not a given, but it pretty much is a given. When there's a rate increase, lenders will pretty quickly pass this increase on to you, the borrower, I'm very, very sorry to say. So if you're on the standard variable rate, expect to see an increase over the next week or so. If you're on a discounted rate, and that's a rate which might be the standard variable rate minus a certain percentage, so it might be the standard variable rate minus 1%, in which case if the standard variable rate was 5%, your rate would be 4%. But of course, if the standard variable rate goes up, you too are also going to see an increase in your rate. So again, expect to see a bit of an increase in rates over the next couple of weeks. Now, the last part of this is those of you that are on a tracker rate. Now, tracker rates, pretty much what it says on the tin, they track the Bank of England's base rate. And so instantly, this is going to see an increase by 0.15%, obviously because the increase was from 0.1 to 0.25. So we're going to see an increase in there from of 0.15%. So that's pretty much going to take place almost immediately, I'd imagine within 24 hours, okay? So that's what's going to happen to those of you that have mortgages at the moment. But what do I expect to see as a result of this rate increase over the next couple of months for new products? Now, as I said at the top of this video, I'm not expecting the Bank of England base rate to go up massively at any month next year. I think we're going to see a number of increases next year. Basically, we're just going to see increases by a small margin until the inflation rate of growth is curbed. That's my prediction. You know, stick my finger in the air. That's my prediction. How is this going to impact mortgages? Of course, I think we are going to start seeing increases in rates. However, we have to understand actually how mortgage products are worked out, okay? So every mortgage product that you see, every product that has an interest rate attached and the various fee structures as a result of that, is actually attached to a pool of funds. Lenders will have funding lines. They won't always lend their own money. In fact, most banks and building societies and lenders in the UK actually don't lend their own money. They have funding lines from other financial institutions. They will compartmentalize a certain amount of money into a product. So that might be a 2-year fixed rate buy-to-let mortgage product at 2.5%, for example. And what happens is that product keeps going until that pool of funds has been exhausted. At that point, the lender will look again at their risk profile, their criteria, the Bank of England base rate, the market, and they will make a decision whether they maybe bring out a similar product to that or whether they go in a completely different direction. So just because the Bank of England base rate has gone up doesn't mean instantaneously lenders are going to be putting rates left, right, and centre. It will have a slow progression into new, more expensive rates being brought out over the next couple of months, weeks and months, I should say. So basically what I'm saying is we have got a little pocket of time here, a little window of opportunity that if you do currently have a mortgage that is maybe coming up for renewal, you're coming to the end of its fixed rate, within the next 3 to 6 months, we can secure those rates. So now is a great time to get in touch with your broker or your lender. I'm not saying you should get in touch with me, but happy for you to do so as a broker. But speaking to these people, speaking to myself, and actually looking at getting a remortgage on the cards early. We actually submitted a case today for a client that doesn't have their fixed rate actually expiring until April next year. And the reason for that, we're getting that cheaper rate secured before lending increases, basically. So any one of you that has, let's go up to maybe May and June next year, a fixed rate that's coming to an end, or a tracker rate, or whatever it is coming to an end, it's worth securing it now. Don't forget the an offer can range in terms of when it expires from 3 to 6 months. So it gives you that opportunity to secure a rate early, get the underwriting done, get the application through to the point where you've got your mortgage offer in place, and then the solicitors can take their time to get the legal work done, and we can just stick a pin in your end date as the date for completion. So my advice, people, time to review now. Get your rate secured as soon as you possibly can, and yeah, that's basically what I would recommend. Now, as a regulated advisor, I have to say to you, don't forget your house may be repossessed if you do not keep up repayments on your mortgage. There's my little FCA bit done. But guys, this is my advice to you. Think about what's going to happen over the next 6 months. This is the start of a few different increases. I can't imagine it isn't, unless for whatever reason inflation just sinks over the next month. Can't imagine that happening. But now is the time to review things, guys. Christmas is a great time to sort of review your finances anyway, and this has been the best time in history probably to do that with what's going to happen in the coming months. So, guys, and it's been a bit of a shorter kind of haphazard type video today. I wanted to get it out nice and quickly, get this information out to you guys as soon as I possibly could. If you've got any questions about what's going on in the market, please drop them in the comments on this video. I'll come to you as quickly as I can, or of course, get in touch with me either on Instagram or email. All my contact details are in the description of this video. So look forward to hearing from you all. Hope this video was enjoyable, and enjoy your weekend. And if I don't speak to you guys beforehand, have a very, very Merry Christmas. Ciao for now.